Hello everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a fascinating microcap that recently appeared on our hard-to-borrow screener, TNON Medical Inc., trading under the ticker TNON. We're going to explore why this stock is drawing attention, what hard to borrow truly means, and the mechanics behind a potential short squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick introduction to TNON Medical Inc. Short TNON logo/info. TNON is a medical device company operating in the healthcare sector focused on developing implants for the treatment of severe lower back pain. Their flagship product is the Catamaran C joint fusion system, an innovative, minimally invasive approach to treating sacroiliac joint pain. With a current market capitalization of just $3 million, TNON is squarely in microcap territory, known for its inherent volatility. Recent price action for TNON has been tough, with today's change showing a staggering minus 22.2%, a minus 31.5% drop over the last 5 days, and a minus 70.69% plunge over the last 30 days. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? When someone wants to short a stock, they first have to borrow shares. The cost associated with borrowing those shares is called the cost to borrow, or CTB fee. Think of it like paying rent on the shares you're holding short. This fee is typically expressed as an annualized percentage. Why does it matter? A high CTB fee signals a few things: either there's very high demand from short sellers to borrow the shares, or the supply of shares available to borrow is extremely low, or both. When these fees climb above 100%, it means short sellers are paying more than the stock's value per year just to maintain their short position. Why the stock is hard to borrow right now? Now, let's look at TNON specifically. Our screener flagged TNON Medical due to its extraordinary cost to borrow fee. Currently, the annualized CTB for TNON stands at an eye-watering 1136.5%. To put that into perspective, short sellers are paying an immense premium just to keep their bets against the stock. With an estimated float of 12.8 million shares and an unknown number of shares currently available to borrow, this extremely high fee suggests a critical scarcity of shares for shorting. Our internal composite squeeze score for TNON currently sits at 41.6 out of 100, which indicates some underlying pressure but isn't in the extreme zone yet. It's crucial to understand that while this high CTB can set the stage for squeeze, it can also indicate strong conviction from short sellers who are willing to pay these high fees because they believe the stock price will fall even further. Squeeze mechanics explained. So, how exactly does a high CTB play into a short squeeze? Imagine this: a stock has a high CTB because shares are scarce. If the stock price starts to rise, even slightly, short sellers begin to feel the pressure from both the rising share price increasing their paper losses and the exorbitant daily borrow fees. If the stock gains enough positive momentum fueled by buying volume, short sellers may be forced to cover their positions by buying back the shares they initially borrowed. This forced buying creates even more demand, driving the price up further, which in turn forces more short sellers to cover, creating a cascading effect known as a short squeeze. It's essentially a race to exit short positions before losses become unmanageable. Dilution risk check. One crucial factor for any potential short squeeze is dilution risk. Dilution happens when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can completely negate any short squeeze thesis, even if the cost to borrow is sky high, because it provides more supply for short sellers to cover with, and it can depress the share price. In the case of TNON, our check found no recent diluted SEC filings such as SMINS-1s, SMINS-3s, or 424Bs in the last 90 days. This is generally a positive sign for any squeeze potential, as it indicates the company hasn't recently flooded the market with new shares. Recent reverse split watch. Now, let's talk about the significant event for TNON Medical. The company executed a 1-4-35 reverse stock split on 2026-8-10, which means it happened literally 0 days ago from when we're recording this. A reverse split reduces the total number of shares outstanding while proportionally increasing the share price. In TNON's case, every 35 shares were consolidated into just one. Reverse splits typically reduce the float, meaning fewer shares are available for trading, which can, in theory, contribute to higher volatility and potentially exacerbate a short squeeze if buying pressure emerges. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, though this is a pattern we've observed in some names, not a guarantee of future performance for TNON. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given TNON's current set of an astronomical 1136.5% CTB, a very recent reverse split, and significant recent price declines, what should traders be watching? Today's volume for TNON was 397,140 shares, which is only about 0.1 its 30-day average volume of 3,841,551 shares. This extremely low relative volume suggests that despite the high CTB, there isn't significant buying interest right now. For potential short squeeze to materialize, we would need to see a dramatic increase in trading volume, sustained positive price momentum, and potentially further reductions in the shares available to borrow. The recent reverse split could certainly introduce renewed volatility, but with such steep recent declines, any upside movement would be challenging. Remember, while a high cost to borrow can be a precursor to a squeeze, it also highlights the conviction of short sellers who are willing to pay those fees because they believe the stock is headed lower. So TNON Medical Inc. TNON presents an intriguing case study. Its extraordinary 1136.5% cost to borrow fee, coupled with a tiny market cap and a fresh reverse stock split, puts it squarely on the radar for those interested in hard to borrow and potential short squeeze plays. However, the recent negative price action and low relative volume show that short sellers are currently in control. As always, high risk accompanies high potential reward, especially with microcap stocks like TNON. Keep a close eye on volume, price action, and any changes in borrow availability if you're tracking this one. If you found this deep dive into TNON informative, please hit that like button, subscribe for more content like this, and let us know in the comments if there's a stock you'd like us to analyze next. Thanks for watching.